Hey everyone, welcome back to another daily analysis brought to you by FXCM. My name is Desmond and I'll be taking you through today's analysis review where we are looking at a nice call we made on US oil. As usual, guys, remember everything in this video is educational in nature. Nothing should be construed as investment or trading advice. So please do your own due diligence before you guys trade. Okay. So today we're looking at US oil, right? So this was posted yesterday. We're forecasting a bounce above this 67.31 level, and we can see price actually bounced really nicely and reach its target, right? And you can see it's I'm saying really nicely because it touched that level, went all the way up, touched the level, and reversed. I think it has since went beyond the take profit level. But how did we get this level? All right, I kind of want to go through this moment with you. Okay, so how do you manage to forecast a bounce from here and for it to come all the way up to here? Why didn't we play it all the way to here? Let me explain this to you. All right, so what we're looking for on this support level is what we call multi swing low support, right? Multi swing low support is when at least two or three levels, one bounce, there were at least two big bounces, right? There was a third bounce that was relatively close, right? So we are bouncing low, we're looking at a fourth bounce. Okay. The important thing about a multi swing low support is that you are technically preferably looking for at least three bounces. Two is the bare minimum, one, two is the bare minimum. If you have something like close to a three, right, then you can forecast a fourth, right? It's a pretty nice, very simple forecast that you can do. Another key thing that you can do is you can also look further back and see whether the price did respond to this level historically in the past, right? And you can see that this level that we're looking at actually, if you if you stretch it way back, right, this level has technically price has responded pretty well to this level in the past. It's a little bit far back, so we kind of just stick to this one over here. Okay, right? Why the bounce kind of happened over here, right? Three major swing lows, right? Notice we didn't put the buy level slightly lower, right? We didn't put it over here because if you had put it over here, we would have missed out the bounce over here, right? It would have happened already. But why did we move it slightly higher, to be about over here? So you look at this, the level of 67.31, which is just about over here, right? 67.3, 3431. It's about here. So we got 31. Just let me edit the coordinates. 67.31. All right, it's just about here. Why it was placed here is because you notice, right? It catches the bouncer here, the bounce here. Most importantly, it caught this little bounce too. Okay, so that's the key thing. You don't need to put the swing low at a major swing low. You can actually fine tune it so that you can catch this one here, right? So you notice that price came down here and it bounced, right? So the key thing about finding key support levels is that you don't necessarily need to put it at the major swing low, which most people do. You can fine tune it so that it catches the most bounces, and then in this case, measure catch the bounce. Why do we play it up to here is the next key level, right? Because this is a nice overlap resistance level, right? And price, we usually play from one support to one resistance, right? The further you put price, we could technically place the take profit here, right? All the way here, or maybe even here. But the further you put away price, right, the more it gets out of your locus of control, right? So a lot of things can happen from here to here. If we notice that there's a resistance level here, we just want to get out because the probability of the price going from here to here is, maybe you have 70% probability of this, but the probability of it breaking this level and crossing up to here, right, this one might reduce your probability to maybe like 40%, right? So that's a problem with it, right? It is you don't want to play moves that are too far, right? Because you play too far, go for the Hollywood trade, you end up losing a lot in the probability of your setup. Okay. Lastly, all right, there was a nice descending resistance line over here. Not sure if you highlighted it. I wasn't highlighted there, but there's a nice descending resistance line, meaning I wouldn't have the confidence of playing it too far because technically price after breaking this would come up to test this descending resistance line, and how strong it is we'll never know. So it's safer to just play it to a level which is within our locus of control. Stop loss, you notice we kept it really tight. It's based on a 78.6% Fibonacci projection, but you could have just kept it even tighter, maybe even like this level here, right? Because you don't need to keep such a wide stop loss. Your hypothesis your plan A is that price will bounce from here. If it bounces, great. If you're wrong, you're wrong. If you're right, it's perfect. Remember that the market rewards you for having a tighter stop loss with a better risk reward. Your stop loss is here, your take profit is here, your risk reward is 3.25. If you put your stop loss further away, your risk reward becomes 1. So the market makes you pay for that comfort, right? Of having a wider stop loss. So always keep that in mind when you're placing a stop loss, right? Don't place it unnecessarily far. Place it only at the level where it makes sense, giving your trade enough breathing space, to work itself out. Okay, that's it for me for today's analysis, right? Please, if you have any comments, questions, or feedback, please send it through. I'll do my best to get to them. Otherwise, stay safe, trade safe, and I'll catch you guys in the next video.